It's almost halftime for the stock market, and what a year it has been so far. Traders started calling it the Teflon market because no bad news would stick. But the Federal Reserve could pour cold water on the sizzling market if it dials back its bond purchases. So is it time to turn cautious, and how should you position your portfolio? Here to weigh in is Uri Landsman, president of Platinum Partners, Jason Raznick, angel investor and founder of financial news websites Benzinga.com and MarketFi.com, and Christopher Sace, founder and editor of Power Trend Profits and host of Power Talk. Gentlemen, welcome. Thanks so much for joining me.
Oh, thanks for having me.
Jason, let me kick off the conversation with you. We had you on the show back in February, and you said you expected the market to ramp up this year, and you were on the money. Will the rest of the year prove as strong?
It has been strong, very strong. As in our, we talked before, it's gone a little faster than I even expected. So I think you'll still see the stock market kind of maintain where it's at, but I don't think you're going to have as big of a climb the rest of the year. I'm not saying sell, but I would be a little more cautious as the economy. I mean, it's still there, but the stock market, the way it's run so far this year, and the every week just going up, I would if you made a big profit, I would hedge with options or take some off and move it to the sideline.
And Chris, you're turning cautious as well here right now, aren't you?
Yeah, we are. It's interesting. You look at the landscape. The market has kind of pulled back a little bit since mid-May. The economic data we've gotten of late points to a spring swoon. So what I'm telling subscribers to Power Trend Profits is we're going to be selective in where we head. We might even average down in some names that have pulled back a little bit. But again, Power Trend Profits, we look at where we're going over 12 to 18 months. So we're setting up for that type of investment landscape, not necessarily where we're going to be in 1 month or 2 months from now.
Uri, it's been 7 straight months of gains for the S&P, and we're starting to see volatility kick back up here. Do you think we're at an inflection point for the market?
Yeah, I really do. I think the 1687 intraday high that we hit a few weeks ago is going to be the high for the year, and I think we're going to start trading off fairly steadily soon. 1600 pretty much held. They've rallied them a little bit on top of that. I think the next time or the time after that 1600 is tested, it's going to fail, and then we're going to proceed to take out various support levels for probably the next 4 to 5 months.
So how low do we go from here?
I think we could threaten 1400 on the S&P this year.
Wow. All right, well, let's talk about the Federal Reserve because its stimulus has been the major ingredient for the stock market rally this year. Uri, since you do expect a downfall from here, what's your sense of when the Fed might taper? Is that what could really knock the market off its perch?
Yeah, I mean, I think that's one of the problems that the market's going to have is that, we've been propped up, artificially in my mind by the Fed. Basically, they've put a safety net under this market. And I think what's going to happen probably late summer is they start finally tapering off their purchases, and they'll probably be out of the market entirely either by the end of the year or by the first quarter of next year. And I think the market is going to have a hard time digesting that.
Jason, you think the Fed was trying to bring down some of the froth in the market by merely talking about tapering its purchases as opposed to actually doing so?
Yeah, a little bit. I mean, the Fed talking sends a huge message to the market. Ben Bernanke's been very clear with how, the rules he uses to raise rates. He wanted that 6.5% unemployment. So yeah, I think talking does send messages. And, Uri was talking about the intraday high. I'm more of a, like Chris said, more of a longer term investor and look for different stock opportunities, and there are still opportunities in different markets. But yeah, I think the Fed does notice what's going on in the market, and do they want to tighten now or taper? It's not clear, but the talk does send a message to investors for sure.
Chris, do you think tapering fears are overblown here? Right, you look at the most recent unemployment report from May, and it was still kind of a tepid number. Inflation still remains low, which would give the Fed some room to keep buying bonds here. Do you think market's gotten ahead of itself here as to the timeline on the tapering?
Well, I think there's a lot of concern, and it really hinges almost, on what the most recent economic data point is. On some days, we get, data that suggests that, the economy is doing well, and then the market sells off because, the thought is that the Fed is going to, taper sooner. Then we get, weak data for example, Monday's ISM manufacturing figures, where we saw the order numbers for May actually contract. Then all of a sudden the market, responds because it says, guess what? The Fed is not going to taper as soon as we think. So I think there's a lot of push-pull, but when I push back from the desk and kind of add up all the figures, it tells me that we're at best at 2%, economy this year, plus or minus. So I agree with Yuri that the way the Fed starts to taper will be key. The big question is when. I do think it's pushed off a little bit. Given some of the economic numbers we've gotten, but I do think it'll happen towards the back half of the year. The big question to me is, as they start to taper off, are they, how fast are they going to taper once they start, and what does the market expect for that? Is it a quick fall off, or is it a progression over, 6 to 12 months?
Well,
that's the real question.
Right. Well, you've certainly seen yields react right in the bond market, and it's created a lot of volatility, uncertainty within stocks. I mean, could we see a major downdrift?
You're asking me.
Yeah, Chris.
I think there's that risk in certain sectors, right? When you see, the 10-year start to creep up, some of the more yield-sensitive names, which have done well, utilities, for example, they might trim back a little bit. Maybe some of the other defensive names. But there's another flip side to that too, which is the 10-year is kind of used to price, mortgages.
Right.
And as the 10-year moves up, all of a sudden we could start to see 4% mortgages return. That could get people who have been sitting on the sidelines into the housing market, which could actually be good longer term.
Well, wait a minute here, because we already are around 4% on mortgage rates here, Chris. If we do see the yield on the 10-year continue to move upwards, and that puts upward pressure on mortgage rates, what's the risk that actually it could cool the housing market and hurt the economy? Because so far this year, right, the economy has been driven in large part by housing.
Oh, no doubt about it. I mean, from where I sit, the two big drivers have been automotive and housing. Both have nice ripple effects. But I think you need to understand really what's driving the rebound in housing. On the one hand, housing is created by jobs. On the other hand, the inventory out there is at multi-year lows. So to some extent, the housing market has to correct in order to see housing start to rebound. So we're starting to see home builders in the DC area really throw up homes. I think that's helping in some other areas. And to me, it says that, 4%, 3.9, 4.1, whatever the mortgage rates are, if we're up off the lows, that's going to spur people into action.
Jason, you run Benzinga.com and you're an angel investor. Last we spoke in February, you said that the economy was picking up from your vantage point. What are you seeing now?
It's interesting. There are opportunities, obviously, with growing companies. We are also seeing companies that, I would say more startup companies that are having trouble where they're not able to raise the next round of financing. And you're going to start seeing, or you're already seeing a little bit of these acqui-hires, these companies that get bought out. Actually, a couple of companies that Twitter bought recently, bought them for very low prices that, it's not publicly disclosed. So, companies that are growing are obviously, are taking advantage of the market. But the companies in the angel space or startup space that, have a business model but aren't, cash flow positive or revenue's not growing, are having a lot tougher time going to that next phase. So what does that mean as a whole? I mean, maybe the venture capitalists are unable to raise as much pension money, insurance money, but that's kind of what we're seeing right now.
Well, on the pre-interview, you told me that you were more bullish on the economy than the stock market, right? You were starting to see things really start to flow.
Yeah, I mean, I'm seeing it with employment and with the caliber of people and the companies around us. I mean, we're in Michigan, and Michigan is in this pretty much a pretty big turnaround, it seems like. Automotive is doing really well, suppliers are doing well, and so maybe it's one state, which doesn't predict the whole country, but we're seeing employment numbers improving here, and there's a lot more companies around us that are doing well, and which so it's for the economy. We're seeing strong growth for the stock market because of the growth that has already happened. It's something that I stay cautious. I'm more cautious now, but there's always individual plays like the ones I had before where there's opportunities. I mean, the market is always there's always a buyer.
Jason,
seller.
do you think that the wealth effect is working?
A bit. I mean, people are seeing the stock market go up. They're seeing their pensions go up. That makes them happier. They'll go out and spend. I mean, you're looking at $4.23 gas prices, $70 to fill your tank, and consumer spending is still there. But that's the one thing that scares me 6 months from now, because you look at your portfolios, your 401ks, your pensions, and you see it going up. But if the market takes a little dip, are those people going to be out there to go buy their clothes at Gap?
Well, I also have to wonder if the wealth effect could be short-circuited if incomes don't increase, right? Uri, what's your take on the economy here? I mean, is business confidence really the key here? If businesses remain uncertain about the outlook and they're not hiring to the degree that the economy really needs right now, are we going to be stuck in this 2% malaise?
Yeah, absolutely. I mean, I think that's the single most important thing driving the economy and the market today, and it's why I'm so negative on the market, because I haven't seen businesses stepping up at all. And just looking from who comes to us to borrow and talking to other lenders, it's not like businesses that even have strong balance sheets are willing to step in there and spend a lot of money on plant and equipment, on new lines, et cetera. And those are the things that employ people. And we have probably, between unemployment and underemployment, a good quarter of the economy that is one of those things, and maybe more if you include the people who aren't actively seeking work. So, I think businesses are focused on that, and somebody's kind of got to take the lead here. I think it has to be small and medium enterprises, and to this point, I haven't seen it. And so it's sort of why I'm pretty tepid on the economy and so negative in the short and intermediate term on the market.
Yeah, switching gears, Uri, I mean, the stock market also seems to be kind of disconnected with corporate earnings. I have in my notes that profit margins are at 58-year highs. I mean, at what point does cost-cutting stock buybacks get exhausted and companies have to rely on sales growth, which grows typically in line with GDP plus inflation, which at this point seems to be anemic?
Well, I think there's two important points there. One is, probably given the impressiveness of margins right now, there probably isn't that much more to go. But even if there is, I sense that for the market to move any higher, investors are not just going to need to see nominal earnings, but high quality earnings, right, as you suggest, driven by top line growth. And so even if companies were able to produce the kind of EPS growth rates that the market is discounting here, 15, 16%, if it comes from things like cost cutting and stock buybacks and other financial engineering, I don't think the companies are going to, quote unquote, get paid for it by the market. The market is going to want to see legitimate organic growth here.
All right, let's talk about how to make money in this market. Jason, where are you finding value now?
I mean, so stocks have risen since we last talked in February. There are some stocks like oil drillers, North American tankers, that has dropped significantly for several reasons, but that have a dividend. I've been buying some different ETFs that have dividends, like technology ETFs that have dividends, because technology companies, as their growth slows, they're increasing their dividends, and I like accumulating dividends. The stocks have risen in the sector, but these are companies that have strong balance sheets, are growing, and have a dividend. The Western Union of this world also has a nice dividend. Stock has fallen again. So those are the kind of plays I'm looking at. Not so much as many high flyers that are going to be like the one up 200% in 3 months. Less of those right now.
Chris, to Jason's point on dividend stocks, I mean, those were really the leaders in the market so far for the first half of the year. Some of those less economically sensitive sectors, we started to see some rotation into the more cyclicals. I mean, what's your sense for the second half of the year? Are dividend players going to be out of vogue, or would you be doubling down there?
Well, it's funny, from where I sit, we look at disposable income being weak, savings rates being around 2.5% for the last several months. And I'm concerned about the consumer. And I agree with Uri, we haven't really seen businesses come in and spend. So I am a little worried about it. I do think that we've seen some of those, what I call, guilty pleasure stocks, if you will, or the more inelastic names, your McCormick's, your International Flavors and Fragrances, they've had very strong runs. I do think we'll see them pull back a little bit. But again, as we go through the summer months, I think we might get another bite at the apple for some of these names, which could set up nice for the second half of the year, maybe even past that.
Uri, if Treasury yields continue to move higher, do dividend stocks lose their luster?
Absolutely. I think we've seen the best that we're going to see in the high yielding stocks for this year. I actually think they are ironically going to lead the market down, even though they're typically the most defensive names, and you would think they would outperform in the kind of correction that I'm talking about. I actually think because they've run so much and because there's other places now, or at least potentially, to go for yield, that they're going to look particularly unattractive, given that their underlying organic growth rates are actually lower than some of the other sectors. So whereas in the kind of correction I'm looking for, you generally think that cyclicals would lead the market down, it may actually be the high yielding stocks that underperform in this environment. So
where are you finding opportunities now, Uri? If you don't like the dividend stocks, do you like the cyclical stocks here or other areas in the market?
Well, I like some commodity plays longer term. I think you're going to see a lot of mergers and acquisition activity, particularly in the energy, power space, maybe even in the mining space. So selected smaller companies there that I think might be sold are interesting. We actually like natural gas as a commodity here. Natural gas has been completely disconnected from all other industrial commodities, including oil, for the entire commodity super cycle over the last 15 years. And so ironically, I think it's going to continue that where just about every asset class is going to be going down, over the next 4 to 6 months. I think natural gas is going to continue its rally.
Jason, you offered up Tesla as one of your top picks back in February. Since that call, the stock's up 140%, so congratulations on the call. What do you do here now? It's got a nosebleed PE of 2,444.
Yep. And the other one that day was Groupon, which, I got a little bit of
yeah, we just about laughed you off the set.
Yeah, I definitely laughed off the set that day, and I think it was around $3. And I was just going by, look at the balance sheet, look at a company, potential new management, and that happened. Now it's around $7. And Tesla, yeah, that stock has risen like a rocket ship. And obviously, a lot of the buyers are buying it because they're hearing about it in the news and momentum. And that's not the reason I bought it, and that's not the reason I still own it. However, do I think it's gotten ahead of itself? Sure. Right now, it's arguably overvalued for where it's at. There's a lot of things that are going to be coming out of Tesla that just it isn't in the stock, though. It's the Google on wheels. If you like Google, then arguably you should like Tesla. Every day, a whole software download comes to your computer. It's an unbelievable company. When they introduce a $30,000 car, I've done analysis. That's even a $200 price target. Then it becomes reasonable with the PE ratios. But it's a risky play. That wouldn't be one I would say go back up the trucks and buy today. It's gone up a lot really fast, just like Groupon. I look for companies that I like. I'm less of a trader. I look for companies that I believe in that can have an impact long term.
What are some gems you're looking for right now, Jason? I know you mentioned some of those dividend players, but are there other tech plays, names you can mention right now quickly?
So yes, sorry, I wasn't an exact target. I try to find stuff that is a really important task that they help accomplish by using the internet. I'm now looking at Echo Logistics because it fell a lot when it had earnings. They're implementing a lot of technology where I think their margins are going to expand. That's ECHO. I've said Western Union. It's more of a comeback play. And those are the kind of stocks that I'm looking at. Salesforce, if it comes back a little, I would be in again there. And Amazon at 270 or so is a tricky one, but it's one that we still like here for a couple of the new initiatives will be starting later this year. And it's just these are things I scale into. I didn't buy Tesla all in one swoop. I sold some Tesla after the big win, but I don't buy stocks in one day. And there's hoping I buy them in increments, and when I really believe in the company and
right. Chris, keeping with the tech theme here, you just wrote something on sensors and how they've really been used in a lot of cars, right? But do you think that there's another leg up to go here?
Well, it's interesting. I was in one of the power talks I did with the head of the Consumer Electronics Association. I kidded him and said, well, it's not cotton that's the fabric of our lives, it's chips. And when you look at where semiconductors are today in a vast number of applications, it kind of proves out. But one of the secrets is, in order for those chips to work in the everyday environment, you need sensors. So sensors, whether it's industrial applications, in the car, around the home, in appliances and things that we have, or even now in wearable computing, such as Nike's Fuel Band, for example, maybe the iWatch from Apple, we'll see. There's a lot of reasons to be bullish on overall sensor growth over the next few years. So one of the companies that I'm looking at is Measurement Specialties, MEAS. It's had a good run, up about 35% or so year to date, but it's looking like there's more upside to be had. We could take a look at presentations from Mary Meeker very recently. She gave her State of the Internet 2013 address, or even Tim Cook at All Things D. And the consensus seems to be that sensors are going to be exploding all around us, and MEAS looks like one solid way to play that.
Jason, what do you think of Apple here?
Apple is a company with a strong balance sheet. They need an innovative product. It reminds me of the 80s when they were winning, and then Microsoft 95 comes out 98, and market share was taken because Apple has its proprietary system at a higher price point, and at this point, people don't always want to pay the high price. And with Android coming on board with different devices, it's becoming harder for Apple to differentiate. So Apple needs that oh my gosh product as soon as possible, because the competition is fierce in this space. I still own Apple, but it's one because I own it because of its balance sheet, and it's not as high growth as it used to be because we still need that next Gee-Whiz product. But I'm not here to say get rid of it, take it out of your portfolio, because it has gained a decent amount of share, and the people that use Apple love it.
Uri, last we had you on the show back in March, you liked the Japan trade. Given that the so-called third arrow of Prime Minister Abe's three-pronged approach to rejuvenate growth in Japan seems to have fallen short of investors' hopes, is the Japan trade over for now, right? The Nikkei's in bear market territory.
Yeah, it kind of got exactly to where we thought it was going to get to, around 16,000. And I think the magnitude of the sell-off sort of surprised us, but it had been such an incredible run that I guess it's understandable. I think it's got to stabilize first before I'd be jumping back in. But if you held a gun to my head and said you have to spend the dollar today, either in the Japanese stock market or the U.S. stock market, I'd invested in Japan.
Do you think the growth prospects then are better in Japan than the U.S.? Or is it the QE that they're doing? Because it's basically like QE on steroids over there.
Right, and they're much, much earlier in that cycle than we are. And while the market's much more volatile and certainly doesn't look good technically right now, I think at some point it can stabilize and be a relatively good place to be, if not a nominally wonderful place to be. But I'm again talking about an environment where I expect U.S. stocks to correct, 20%, over the next 6 months. So, you don't have to perform very well to beat that.
Mm-hmm. All right. Well, gentlemen, great discussion. Thanks so much for the insight. I so appreciate it. Hope to see all of you again soon.
Thank you.
Thank you.
Thanks for having us.